What did we learn over the last 3 days here about the demand for treasuries?
Yeah, I think we're learning that we need a little bit more of a risk premium in the treasury market in order to absorb this larger supply in auctions. I think, if you saw by the inflation data today, inflation's not coming down in a straight line. That's a little more term premium associated with fixed income markets, a little more unknown uncertainty as to where inflation lands, a little more unknown and uncertainty as to the Fed's reaction function and exactly their path. And so all that means a little bit more premia in fixed income and in bond markets, and that's what we're seeing today.
What's interesting, though, is that, say, yesterday, the action was really in the front end, right? And then today, it's pretty much all across the curve. Did what we learned today from the CPI really mean higher for longer, which really means higher 10-year down the road?
I think it's an unknown, and I think it's a possibility. I mean, I think the economy's been quite resilient to these levels of rates. It's been regurgitated for some time that these rates are restrictive. It's really hard to see these rates necessarily restrictive, whether it's in levels of growth or whether it's in levels of inflation. And so I think the jury's out on how high rates need to be for how long, and just where the Fed can cut to. So I think that's an open question, and I think it's one that markets are starting to process, and more data, more time will certainly help us answer that question.
Well, how are you positioning around that question, Mike? Obviously, you want to be as much out in front of it as you can possibly be here. There's already been a lot of activity, as you've seen, probably on the longer end of the curve, at least relative to the activity maybe that we didn't see a couple of years ago.
Yeah, I think first and foremost, we're positioned on the intermediate part of the fixed income market. I think that's where we find the most value. You can get yields there of 4.5% to 5% in U.S. Treasuries. You can get with some spread product, 5.5% to 6% returns. You don't really need to take a whole lot of duration risk. You don't really need to take a whole lot of excess credit risk in order to get some pretty decent returns, and returns that can rival those of equity markets. I just want to take a step back. If you look at what happened last year we got the economic data wrong. It was the most called for recession in U.S. history that never happened. We thought the Fed was going, the markets thought the Fed was going to cut. They hiked. And then finally, issuance was higher than expected. So you got all three legs of the stool wrong, and yet fixed income returned 5.5% last year. And I think it's a really good reminder that, starting yields are really important for future returns. And so I think the yields on offer today really attractive, and again rival those of equity markets. And we're encouraging investors to look at fixed income and increase allocations to the asset class.
So when you look at that gap in basically what is deliverable on the yield side in equities versus what you get in the intermediate part of the fixed income space, Mike, do you anticipate at all that any actions the Fed takes this year, whether it's multiple rate cuts or even that rate hike that some people have started to talk about, would that change the dynamics at all for you and your positioning?
Yeah, I mean, it could change a little bit, but in terms of an asset allocation perspective, again, if we are in a situation where we take hikes out or take cuts out or even potentially put hikes in, I think that's a scenario where, if you think about fixed income markets right now, we can sell off 75 basis points and you'll have a zero return in fixed income. I think if we move 75 basis points higher in yield, that will really weigh on risky assets. So even from an asset allocation standpoint, we find fixed income really attractive. And again, if we just sit here and rates don't really do a whole lot, you'll get that 4.75%, 5% return on treasuries, and even more than that with some spread product in your portfolio. So yeah, really a lot to like about fixed income relative to risky assets.